Stock investors most frequently think about gains and losses on stock. However, there's another component of your total return on stocks, and that's dividends. And I want to talk about some myths related to stock dividends. As I said in the opening, when investors think about stocks, they mostly think about gains and losses on trading stocks, and sometimes they don't think about dividend payments. But dividend payments are another way to profit from stock investing, which is why I think it's valuable to have a conversation about earnings. So there's some facts and myths about dividends. First of all, let's talk about what a cash dividend is. It's a share of company earnings paid to shareholders. The board of directors decides when and if a dividend is paid. And there's some myths about dividends. First of all, myth number one, a company must pay a dividend when they generate earnings. That's false. There's no obligation to pay a company dividend if you have earnings. Many profitable companies, including high growth companies, think tech companies, retain all their earnings in the business and don't pay a dividend. In fact, Microsoft went public in '86, didn't pay a dividend until 2003. If you have a net loss, you can pay a dividend. That's a myth. You must have earnings to pay a dividend. If you make a payment to shareholders after generating a loss, that's a return of capital. That's not a dividend. Another thing, dividends must be paid in cash. Also not true. You can pay a stock dividend. Instead of cash, you pay additional shares of stock. So for example, Premier pays a 10% stock dividend to all shareholders. Investor salary owns 100 shares. She would receive 100 shares times 10% or 10 more shares, and she can profit because those 10 more shares can increase in price, and they can also get a cash dividend or both. Another point, only common stock shares earn a dividend. That's a myth. Preferred shareholders can also earn a dividend. And the word preferred obviously means better. The reason that preferred stock is better when it comes to dividends is that the preferred shareholder receives their dividends before common shareholders. And in some cases, there's not enough earnings to pay the dividend. Only the preferred stock dividend gets paid. So let's say you get a cash dividend. Well, how valuable is it? How do you value it compared to other investments? And you can look at dividend yield and dividend payout ratio. Dividend yield reports the rate of return on a dividend divided by the current market price of the stock. So let's say Premier Manufacturing pays a $1.25 dividend. The stock's trading at $60 a share. The dividend yield is 125 divided by the $60 market price, or 2.1%. So you can think about it this way. When you buy Premier common stock for $60 a share, you are buying, quote unquote, a 2% dividend return. Another question is, well, if a company has earnings, how much of those earnings get paid out as a dividend? And the answer is the dividend payout ratio, which is the common stock dividend in dollars divided by earnings available to common shareholders. Because remember, the company can keep the earnings or pay a dividend, or some combination of both. So if earnings per share is $2.50 for the common stock, the company decides to pay out a $1.25 dividend, that is a 50% dividend payout ratio. So obviously, a higher yield is more attractive, and a larger dividend payout ratio means the company's paying a bigger percentage of earnings as a dividend. There's one more point I want to make on when it comes to dividend investing, and it's down here. You need consistent earnings to pay a dividend. So if you pay a large percentage of earnings as a dividend, that means you need fewer earnings to run the business. So a profitable company with a large cash position and a low amount of debt doesn't need to retain a large percentage of earnings. They are financially healthy enough to operate without keeping the majority of their earnings for business operations. So Procter & Gamble's been profitable forever, pays a good dividend. That company probably needs less earnings to fund the business. So those are some points about dividend myths and also the financial benefits of a dividend. When you're thinking about investing in stocks, remember that you can profit from gains on the stock, but also on dividends. So pay attention to the dividend payout ratio and the dividend yield, because that's another component of your total return.